It's my pleasure to introduce what I think is a fantastic panel. We're going to invite the panelists one by one to come up, give their presentations, and then we'll all sit for a moderated discussion. For those of you that are algorithmic traders or think like algorithmic traders, there's a secret algorithm in the order in which the panelists will give their presentations. The panelists are unaware of this, so we'll see how many of you can figure that out. I'm going to introduce everyone and then let them come one by one. First will be Tom O'Shea. Tom has over 20 years experience in the financial services industry prior to joining Cerulli Associates. He played a leadership role at Fidelity. He's a Harvard graduate. Following Tom will be Susan Lund. Susan is a partner at McKinsey & Company and the leader of the McKinsey Global Institute, which produces must-read economic information and analysis on basically the state of the world. She holds a PhD from Stanford University and is frequently cited in the media and gives major economic and public policy addresses. Following Susan will be Charles Himmelberg. Charlie, as he's known, is head of credit and mortgage strategy research at Goldman Sachs. Prior to joining Goldman, he served as research and academic positions at the Federal Reserve Bank of New York, Columbia University, and previously reserved the Federal Reserve Bank of Chicago and the World Bank in an advisory role. Next will be Josh Gaupbaum. Josh is a guest scholar at the Economic Studies program at Brookings. From 2010 to 14, he directed the U.S. Pension Benefit Guarantee Corp, or PBGC. Prior to that, in the Clinton administration, he was Assistant Secretary of Treasury for Economic Policy. And then closing out our panel is Tim Cohen. Tim is the Chief Investment Officer at Fidelity Management Research Company and the investment advisory arm for Fidelity's family of mutual funds. He served a variety of roles at Fidelity previously and is a Wharton grad. So with that, let me hand it over to Tom to start us off.
Thank you so much, Aaron. To get us started this morning, I'm going to focus on the practical aspects of investing in retirement given the low returns in today's capital markets. And I was wondering if, do I just have to hit a button to project my slides, or? Okay. Okay, thank you very much. So the average 401k balance is a little over $79,000. Now, when you look at financial advisors and you study their target market by the size of investable assets of their clients, you'll find that only about 8% of advisors focus on clients with less than $100,000. The vast majority, 92% of advisors, want clients with assets of more than $100,000. The issue here is that advisors, financial advisors, need to get paid, and it's very difficult for them to generate meaningful income from small balance accounts. Now, most advisors will assume that the sustainable withdrawal rate for a retiree is about 4% on their retirement assets. This figure is based on a study that was done by some professors at Trinity University in Texas. There's a couple things to think about this. First, the capital markets were offering a lot more in 1998 when this study was done than they are today. So many academics have questioned whether 4% can really be a sustainable withdrawal rate, considering how low the returns of today's fixed income and equity markets are. But let's assume that 4% is a good number. And let's assume that instead we're dealing with the average rollover IRA balance, which is about $119,000. Now, what's 4% of $119,000? It's $4,800. That's not really meaningful income per year for a retiree, is it? Now, fees are another issue. The average balanced mutual fund in a 401k charges about 66 basis points to the plan participant. When the participant rolls over their 401k into an IRA managed by a financial advisor, they often roll it into, say, a mutual fund wrap product. That's the typical product that they land in. And that advisor charges roughly 198 basis points, or 1.98%. Now, 1.98% may have been acceptable when capital markets were offering balanced portfolios at an 8 to 10% return. But as that number drops to 5 to 6%, the fee becomes a meaningful portion of the client's return. It's as if the tide has receded and exposed all these rocks on the beach, and these rocks are, guess what? Fees. Also, it's interesting to note that a sizable portion of the fee is not readily apparent to the customer. The fees for most mutual fund and exchange-traded funds come out of the net asset value of the fund, and the client really never sees the money being deducted or feels the cash moving out of their account. And when we survey consumers, interesting statistic, 25% will tell you they don't know how they're paying for their advice. Another 25% will tell you that they're getting their advice for free. So there's a lot of lack of understanding about fees from consumers. Now, there's an emerging class of advisors, which we term digital advisors, but which are typically known in the industry as robo-advisors. These firms typically charge only 25 basis points for advice and use passively managed exchange-traded funds, which cost about 10 to 20 basis points. These advisors remove the human advisor to a large extent and replace this person with a website and an algorithm that allocates clients' investments across asset classes and rebalances these investments regularly. Based on modeling we've done at Cerulli Associates, we anticipate the market for digital advice for robo-advisors to grow to about $489 billion by the year 2020. Several venture capital funded firms, notably Wealthfront and Betterment, pioneered this approach to investing, but it is rapidly being adopted by major companies. Vanguard and Charles Schwab have launched digital advisors in the past couple of years, and Fidelity Investments is scheduled to launch one later this year. There may be a limit, though, to how much consumers will accept technology as a substitute for human advice, at least in the short term. Based on our research, even the most technologically inclined cohort of investors, which most people in the industry consider to be the millennials, they don't completely buy into the notion of online advice. Almost half, or about 46%, do not want an exclusively online advisor. This number may change over time, but this is sort of where we're at right now. Apart from client dissatisfaction with digital advice, there may be some regulatory issues with this product. The FINRA has taken some of our research looking into the dispersion in the way these digital advisors invest client assets and pointed out the importance of understanding a little bit better how their algorithms are constructed. Additionally, this month, the Massachusetts Secretary of State published a position paper questioning some of the practices of digital advisors and wondering whether they were true fiduciaries. The paper reveals a lot of digital advisors disclaim fiduciary obligation in their contracts, something they can't do and still claim to be an advisor under the Investment Advisors Act of 1940. The paper also argues that there may be some inherent problems in acting as a fiduciary without having a person involved. For instance, they say, can a website really determine whether the client is of sound mind without actually interacting with them over the phone or in person? Still, these consumer and regulatory concerns aside, the industry really needs to figure out a way to scale the delivery of financial advice so that the costs are reasonable. 15 years ago, when the capital markets offered substantial returns to client portfolios, consumers might have been able to afford high fees. But the reality of today's low returns is that every dollar counts. Consequently, it's important for financial firms to figure out how to leverage technology to deliver financial advice in the most efficient and cost-effective way possible. Thank you.
Hello, thank you for inviting me. We have a very fascinating session today. I'm going to take a step back and share some of our research that looks at the history of equity investing in the U.S., and I'll share some results of forthcoming research about what we can look at in the years ahead. So first of all, for the history, public equity investing is a distinctly Anglo-Saxon phenomenon. Here in the U.S., virtually everyone in this room has grown up in an era where it's been many people hold shares, invest in stock markets. We watch the indexes every day. We hear it in the morning, we hear it in the evening. But in virtually most of the rest of the world, this is simply not the case. So stock market capitalization in the U.S. is about 140% of GDP. In the United Kingdom, it's 130%. And Australia and Canada have relatively deep and liquid equity markets as well. But when you go to Western Europe, think France, Germany, Spain, equity market capitalization is only 80% of GDP. And then in the emerging market world, it's even smaller. China at 70%, India and developing Asia at about 50 to 60%, until you get down to Africa, 35%, and Eastern Europe, less than 30%. So how did this come about that we and our British brethren and other Anglo-Saxon countries developed this fondness for retail equity investing? Well, there were a couple things and a couple market design choices back in the 1950s that opened the doors for retail investor participation in equity markets in the U.S. Part of it was a push to democratize shareholding. After World War II, when many people bought war bonds, there was a shift towards realizing that there was another avenue for households to build wealth. And this was in the form of equities. And it was considered somewhat patriotic to buy shares of Coca-Cola or General Electric or the big corporations of the day. It was also a good inflation hedge. There was a lot of public education about equity investing, and holding shares became a common thing to do. But in the rest of the world, that's simply not the case. So as we look to the future, one thing to note is there's nothing innately human about being attracted to equity investing. Indeed, this is a construct that's been nurtured over time. Now, when we look at what's happening in the U.S. already, several factors are reducing retail investor appetite for equities. So when you look at the share of household financial assets in the United States, the portion devoted to public equities has been declining over the last 15 years steadily. You see a same trend in Europe. There are a couple factors at play here. One, the population is aging, and as people near retirement, they've been told to shift into less risk-averse types of investments like bonds and other fixed income deposit type accounts. That's playing a role. A second shift has been the shift from defined benefit pension plans, where assets are managed by professionals, into 401k plans, where individuals themselves choose their asset allocation. And what we see clearly time and again is that individuals choose a less risky, more fixed income oriented portfolio. So when you look today at the asset allocations of defined benefit versus defined contribution, you see that equity holding in defined contribution plans is much lower. So what happens as we look ahead? In 2 weeks, we're going to be publishing a paper looking at the past and the future of equity and fixed income returns in the U.S. and Europe. And to give you a preview of what we're finding, it's that whatever golden era we've had over the last 30 years of returns, it's very likely to come to an end. So in the U.S., real equity returns between 1985 and 2015 were 7.9%. Western Europe was only slightly less, 7.7%. That was 140 basis points higher than the 100-year average. So we looked at what caused equity returns to be so healthy, and is this going to continue? What we found is that we model equity and fixed income returns based on what happens in what we call the real economy. And when we do that, unlike many financial market analysts, we find that there are 4 critical factors over the last 30 years that explains why investors did so well. One is declining inflation rates from the 1970s and 80s, and along with it, declining interest rates. Declining interest help boost corporate profits and help shift a substitution in portfolios towards equity. In addition, we had very robust global GDP growth. We had people entering the workforce, not only in advanced economies but emerging markets. We had strong growth in China and other parts of the emerging world. And then finally, we had an extraordinary 30 years of profit growth. You see that in North American publicly listed companies, profit margins grew by 65% over that period. Globally, you see that net corporate income growth outstripped global GDP growth by 70%. So today, in most countries around the world, corporate profits as a share of GDP are higher than they have ever been. Now, when you look forward, you can see that those four factors have run out of steam. Inflation is low and interest rates are low, hard to see further declines, and in fact, interest rates may well reverse. Global GDP growth is no longer being fueled by the number of working age people. In Europe, in the United States, even in China, Japan, Korea, what you see is aging populations. And so in the absence of significant pickup in productivity growth, we calculate that global GDP growth is going to be 40% lower than it has been in the past 30 years. And then finally, we look at what's happening in the corporate landscape. Well, certainly there are new technologies on the horizon that could boost corporate profit margins. But it's hard to see that they would continue to grow or certainly increase as a share relative to global GDP in the same way that they have. So in the two scenarios we look at going forward, we see equity returns falling by 150 to 250 basis points below what you saw in the last 30 years. All of that paints a very cloudy picture for the future of equity markets, for investor interest in equities and the returns they're going to get. It makes market structure and market performance ever more important, as some of my other panelists will discuss. Thank you.
Well, thanks for having me here today. I want to first start with a couple disclaimers. First, that my views represent my own and not the official views of Goldman Sachs. I sit in the research department of Goldman, and I'm obligated to tell you my opinions to the best of my ability to discern what's going on in the world. I also want to offer the disclaimer that I'm a strategist, which means that I talk to investors like Tim and his colleagues about what's going on in the market. And I always think of my job as professional brainstormer, right? My job is to write short notes and talk to investors. I spent yesterday in Boston meeting with half a dozen or so big institutional investors who are managing portfolios on behalf of mutual funds and the like. And essentially what everybody is trying to figure out is what's the sensible, smart thing to do? Where should I be investing? How should I be investing? So that's my touch point to the markets, is really on the wholesale institutional side. We obviously at Goldman Sachs serve those clients by providing market intermediation services. So I might be a slight departure from the other panelists in the sense that I have a perspective that I think is informed by the issues and the problems that traders, institutional professional traders in the markets are facing on a daily basis, as opposed to the experience that I have, for example, when I use my Fidelity account, which I have, to execute my own trades for my own investments. So that's my perspective. I just wanted to give that context. Susan made an interesting comment about the U.S. and U.K. markets and how distinct they are in the global experience, in the sense that they have the biggest, deepest, most liquid, by most measures, most successful equity markets. I want to make sort of an unusual tangent, take an unusual tangent from that observation to point out another similarity between the U.S. and the U.K., which is that they also have the most successful patent systems around the world. And I actually had to do a little work on this to learn this. The patent system in the U.S. is over 3 centuries old, but it predates the U.S. It actually started back in the 1600s. It actually predates that, monopoly grants, but the modern motivation for patents, which is to grant market power to subsidize innovation and growth, that actually has roots that go all the way back to the 1600s in the UK. And the reason I wanted to start with that metaphor, I guess, is to point out that it's kind of a remarkable accident of history, maybe not an accident of history. There was obviously a lot of thought that went into the innovation, the development of the patent system and its evolution over the centuries. But the goal of the patent system is functional, right? The goal is to create incentives that foster innovation and growth and productivity in the economy. And I want to argue that I think a question that we are not asking, either in the industry or in policy circles or in academic circles, a question we're not asking ourselves enough is, what is the functional role that we want to ask capital markets to do? Now, I was an academic. I'm a PhD economist. I taught Columbia and NYU for over a decade. So I speak with some authority when I say, I think academics, at least, take it for granted that markets work, right? Whereas the experience of my new career in the last decade, talking to folks like Tim and his colleagues, is that markets work pretty good, but they're working less and less well all the time. And so the message I really want to give is that, and again, I'm just the messenger, right? I actually don't have an answer for you, I'm afraid. I have some thoughts about what the answer might be. But the message I have is that when I talk to investors, my goal, so I'm a fixed income strategist most of the time, although I now do both fixed income and equity. But my objective, my day job, is to talk to investors about what's the smart way to be investing in the market, where are the expected returns the highest, right? Where should I be allocating the portfolio? For the last 2 years in the credit market, I've only been talking about one thing: liquidity. The market doesn't work. My research assistants have figured out, these 20 names that we think are undervalued and offer great value to our investors. We can't actually source the bonds. We go to the secondary market to buy these bonds, and let's say we want to buy a $25 million position for our portfolio. After we've traded $2 million, the price value that we saw in that bond in the first place has already been priced away. And why is that? Because everybody in the market knows that we're trading. Everybody knows that we've done research. And as a result, the market is trading in front of us, and we can't actually implement the risk, or benefit from doing the research on the idea in the first place, because the minute we try to implement the research idea, the price moves against us, and we're stuck. So what does that have to do with R&D? I think that we should be asking the question, this is what's been on my mind for the last 2 years, talking to traders in the market. I think we need to be asking the question, from a regulatory perspective, what do we have to do to have high-quality markets, where the quality of the markets is not just the types of things we heard from in the opening address in the discussion having to do with the retail experience, but also quality of markets from the functional question of, are capital markets generating the information about the allocation of resources in society that's helping to foster growth and prosperity. I would argue that we're heading in the wrong direction just based on my gut feeling talking to folks. It doesn't seem like the markets pay institutional investors, whose job it is, after all, to be smart about where's the highest marginal valued project in the economy, where should our society be allocating resources that have the highest returns in terms of growth and prosperity. I don't think that the market is compensating the private actors who are investing in the market to produce the amount of information that we take for granted in the finance departments and in policy circles just automatically happens by magic. It doesn't happen by magic any more than innovation and research and development happens by magic. Those things are not magic boxes that just spring forth, year after year of manna from heaven. They're actually deliberate policy decisions to foster the functional behavior of markets in a way that we think is socially desirable. So what I think we're missing in discussions about the retail experience, which are obviously important, I don't want to address that at all, except to say that I think policy has actually done a good job of focusing on fairness issues and transparency issues and fiduciary duties. Those are sort of transparent goods in my view. But at the same time, I think sometimes that focus has come at the expense of disregarding or not fully appreciating the social value of asking what's important to do for the institutional markets from a functional perspective that we care about. So I want to just leave it there. I'm really asking a question more than answering one. But I do think keeping the R&D metaphor in mind is important, because I think that we want to have quality markets that are defined, where we define quality as not just does it provide a good retail experience for day traders sitting at home, in front of their computers, but does it also provide a good opportunity for institutional investors to basically express informed trading ideas in the market, and not have the market sort of disincentivize that research. I think that will come up in the discussion because, for example, it addresses issues of active versus passive management of funds. And one way I always like to ask this question is, do we want a market where 100% of the investment activity is passive? And would a market where 100% of the investors were passive have any information that was worth anything at all? Would our market still be the envy of the world?
All right. Nope. Let's see. I think I was supposed to already know how to do this, but great. I'm really glad that Martin asked me to join this panel. I'm really sad that one only gets 7 minutes, and but I'm also glad that Tom O'Shea provided slides, so I don't feel quite so odd. The most widespread form of equity ownership, directly or indirectly, is through tax-deferred retirement accounts. My view, and taking a tip from the previous speaker, I should point out the fact this is my view, it's not Brookings' view, or Brookings Management's view, or Brookings Trustees' view, et cetera, and it's not even probably Martin Bailey's view, is that regulation of retirement accounts drove the change from corporate plans to individual accounts. And this, in turn, completely changed the market for retirement investing from one that was overwhelmingly institutional to one that is broad-based in retail. The financial services industry has figured this out. They've adapted. Government is only beginning to do so. Widespread adoption of traditional pensions didn't occur until after World War II. As you can see from this graph, the percentage of private workers covered by a defined benefit plan rose from 20% in 1950 to just a little less than 40% in the mid-70s. Ironically, the passage of ERISA, which was intended to protect traditional pension plans, instead began their decline. Employers decided that they didn't want to be solely responsible for funding retirement, that they didn't want to be responsible for insuring against longevity risk, having fiduciary responsibility, having the market variations of pension funds reflected in their retirement, in their financial accounts. So they switched to defined contribution plans and reduced their financial and legal obligations. This converted tens of millions of formerly employees into investors. In 1979, which was the earliest date for which we have data, most private sector workers who had any kind of employer-provided plan had defined benefit pensions, all of which paid out as annuities. They had no decisions to make. By 2011, only 14% had a defined benefit pension plan, and most of those plans had lump sum options. In other words, they started to make decisions. 42% had defined contribution plans, with the percentage paid in annuities has been continually declining. With the advent of defined contribution plans, individuals became responsible for deciding whether and how much to save, but companies could still help them. They could negotiate fees and limit manager and investment choices. They could set up a default investment option, and they could auto-enroll their employees. Unfortunately, the shift from defined benefit to defined contribution was only the beginning. The more significant move was from both defined benefit and defined contribution into individual retirement accounts. In 1974, about 3/4 of retirement assets, and I'm switching to an asset case here just because it's where we have data, about 3/4 were annuitized. 19% were actual annuities, and more than half of the rest of the assets were in defined benefit plans, all of which were paid as annuity at that time. By 2015, by comparison, 3/4 of retirement assets are either defined contribution or individual retirement accounts. I would also note, and this is most important, that in 1974, the fraction of assets that was in individual retirement accounts was minuscule, 0.4%. In 2015, it was 39% and growing. With the individual retirement account, the transition of retirement saving and investing responsibility from corporate sponsors who knew what they were doing, who invested professionally, et cetera, to individuals is complete. Employers can do nothing. So then, how well do we think the individual retirement investor is doing compared to the institutions or compared to the high net worth individuals, which is what we used to consider individual investors being? My answer, quite badly. Let's be clear, these are not day traders. Just to note a few of their limitations, Tom O'Shea mentioned fees. Fees have been the subject of extensive discussion, extensive disclosure efforts, attempts to educate people. And despite that, most retail investors have no idea what they pay. As Tom pointed out, 1/4 of them think that these services are free, and 1/4 admit they have no idea how they're paid for. My favorite one, actually, from this list of decisions that consumers implicitly have to make is asset allocation. Olivia Mitchell and Anna Maria Lusardi, who are experts in financial literacy, nonetheless have documented how little of it there actually is. They asked a sample of folks which was safer, to invest in a single stock or to invest in a mutual fund. There were only 2 choices. You had a 50% chance of getting it right. Guess what percentage of the population guessed right? 52%. One could discuss this for days. However, I have, I think, 2 minutes left. So I think the critical challenge here is that because this is a new market, we need to think of consumer protection differently than we have for traditional institutional investors or even traditional high net worth individuals. Now, the good news is that for the portion of this population that is still in the employer-provided plan universe, 401ks, employers are taking these limitations into account. They're doing auto-enrollment. They're constraining choices. They're negotiating terms of products so that, as a result, fees are considerably lower than, again, as Tom O'Shea, thank you very much, pointed out, they are when people enter the IRA market. However, employers still can't help employees with withdrawals. They can't help with annuitization. And when it comes to IRAs becoming the dominant retirement vehicle now, companies can't help at all. Individual investors are entirely on their own. So who then can help? Let me be clear that this is not a ding on the financial services industry. They are doing their job. They're getting customers, et cetera. The financial services industry has adapted to its new customer base, but government is only beginning to do so. There's plenty of regulation, as everyone from the financial services industry will tell you, but it is impressively out of date. The SEC model, and the SEC is full of very talented, very intelligent, very well-meaning people, nonetheless presumes the sophisticated investor that these folks are not. The Department of Labor started in this world not by paying attention to financial services providers, but by regulating employers. However, employers are getting out of the business. So now the Department of Labor has to wrestle with how to handle financial regulation, service providers. I view its conflict of interest reg as a start. an attempt. Clearly imperfect, clearly attempting to get better, but that's what it is. And it is part based on a disclosure notion and part based on a prohibition notion. Now, I don't have a considered judgment as to what ought to be done here, but I think it's worth noting as a person who's been both a regulator and a regulated for most of my life, that there are lots of options. To name a few, there could be disclosure that people could actually understand, written by English teachers instead of lawyers. Or you could require disclosure on an annuitized lifetime income basis so that people have some sense of what it is they're getting. The Food and Drug Administration regulates the marketing of drugs. You could think about overseeing and regulating the marketing of financial services products. In other regulatory arenas, you could have, they actually attempt to standardize and define products so that you can actually have comparisons and do shopping for products. So there are lots of possibilities. And then there is the turf problem. Here too, which is who regulates. This is already like my kids' soccer game, which is you have lots of folks going after the ball, and they are the opposite of a team. Here too, I can't tell you, I don't have a considered opinion, I just have a few observations. Number one, DOL, when you look at the Department of Labor, has regulated largely by preserving the threat of fiduciary liability. But they have thus far generally avoided specifying the terms of products, their marketing, or their fees. It's not clear whether they can. Sadly, the Consumer Financial Protection Bureau, arguably a plausible source of help in what is, in my opinion, the single most complex consumer financial decision, was prohibited in Dodd-Frank from entering either the Department of Labor's or the Department of Treasury's turf. So, can't say who. What I can say confidently in closing is that this is an entirely different class of investors, that they will need consumer protections, and that we are at the beginning, not at the end, of discussing how to protect them. Thank you.
Good morning, everyone. Thanks a lot for having me here. I'm Tim Cohen from Fidelity Investments, and like my predecessors, I'd like to start out by saying these are my opinions, not official opinions from Fidelity. A lot of my comments today are going to echo what we've heard from prior panelists, but I'm going to really drill down on the active versus passive debate in terms of which one's better, and also talk a little bit about the policy angles that I think people should be thinking about in active versus passive investing. So first I'm going to talk about a little bit about the data, which one is better. And compared to everything else that most have read, that I've read in the press, this is probably going to sound a bit like a man bites dog story, because you probably haven't heard it too often. And then I'm going to drill in on the policy side. But first, the man bites dog story. I'm going to argue that good active funds are a better investment choice, at least historically, than good passive fund strategies. And the second point, which is critical, is it's actually not that hard to find good active funds for the average investor out there, even in advance without hindsight bias. So I'm going to give a simple view of the data. Some of it will sound familiar and some of it might sound new. When you drill down on the three largest fund categories that Morningstar would define for U.S. mutual funds, the first one is U.S. large cap funds, which is by far the farthest. And the simple data there show that the average active fund has underperformed the index by about 71 basis points. We look back over about 2.5 decades and looking at the data. And that would show that the average fund is doing a little bit better than the index before fees, but after fees, it's trailed. The next two biggest categories of mutual funds out there are U.S. small cap stock funds and international funds. And in those, it doesn't get nearly as much press, but the average active fund has outperform the indexes by close to 100 basis points a year, close to 1% a year better performance for active mutual funds, the simple averages compared to the indexes. And now I'm going to drill down a bit on that first category. That's one that far and away gets the most press. It's the biggest category, and it looks challenging for the active fund industry, which I live in, day to day. When we drill down behind the data, everyone's heard the phrase about lies, damn lies, and statistics. Well, I think that really applies in spades here. The math is correct, but some of the assumptions behind it, I think, are silly and not what the average customer out there really experiences. So if I asked everyone in the room to consider investing in two different funds, the first Fund A is managed by one person. It has $5 or $10 million in it, so very small from the fund consideration, and charges about 1.5% in fees. The second fund, Fund B, offered by a large company like a Fidelity, a large fund management firm, a global investment team with research analysts and traders and portfolio managers all around the world, talking to companies every day, digging up ideas, trying to come up with some of those good ideas that Charlie was talking about before. And by the way, that fund will probably charge about half the fees, about 75 basis points per year in fees. To me, it seems like a very simple decision. But if you think about it, that second category, which has attracted about half of the assets in the industry, is a very small fraction of the number of funds. When you look at, when we study the data, there were over 2,000 funds in the Morningstar database. And this database is survivor bias free going back over that time period. Over 2,000 funds, a small fraction of them fit that category. But those funds have gathered about, or those fund families have gathered about half the assets in the industry. Customers are smart. They don't go out and buy the average fund. They buy funds from well-resourced firms with low fees. And the statistics bear that out. So we sliced the data and looked at funds that are from the top 5 fund families, which again have about half the assets in the industry, and charge fees that are in the bottom quartile of the universe. The cutoff today, it varied over time. We looked at this month by month for going back years. But the cutoff today would be about 80 basis points in fees. And the funds that met those criteria beat their benchmarks by about 18 basis points a year after fees. Almost 1% better than that simple average I gave at the beginning, which was minus 71 basis points. Another point that's important to remember is that passive funds, while a good option, and we offer them at Fidelity, they don't match the index perfectly. The average passive fund out there, which can include varying levels of fees, actually delivers about 35 basis points per year less than the index. And really good performing funds, we did similar filters on the passive side, underperform the benchmarks by only 4 or 5 basis points, which is frankly what most folks in the room, most well-informed customers would choose anyway. But you're still getting about 22 basis points a year better from the average active fund that met our filters compared to the average passive fund. And while that's not headline grabbing, it is very meaningful, especially when we think about modeling a retirement savings time frame that's going to be about 45 years for the average saver in a 401k plan and another 20 plus years in the distribution phase. An extra 20 or 25 basis points is meaningful. It adds years to the retirement income of the average customer. The second part of the discussion I want to talk about is the policy side. Why should, we're here in Washington, D.C., and why do we think, it's certainly an argument we want to make with our customers and let them know about the power of good active management. But why do we think policymakers should be concerned about it? Some of these themes have already been discussed by the other panelists. But I'm going to walk through what I think are a series of indisputable facts. They're going to lead us to the conclusion that this is something that policymakers need to think about and need to be concerned about as we go forward. So the first point is that I think vibrant capital markets, stock and bond markets, are a critical part of a strong and growing economy. It allows companies to access new capital to grow their businesses, create jobs, and grow the economy. I know it's popular recently, especially for some to vilify the markets and market participants, but I think this link between healthy markets and a healthy economy is indisputable. In fact, some of the statistics that Susan cited, the economies that have had vibrant capital markets have had very strong economies, and I think are really the envy of the world. The second point I want to do is make a distinction between primary markets and secondary markets. Primary markets, no one ever throws stones at. Primary markets are companies going to the market for an IPO or a new bond issuing, raising new capital to help grow their businesses and grow the economy. That's always viewed as a positive. It's a secondary market activity that often gets the stones thrown at it, called speculation or other things. But a strong primary market is impossible without strong secondary markets. That's a very definitive link that we need to keep. The third point is passive investing, the entire concept, is essentially a free rider on an efficient secondary market. The entire basis of it is that investors can buy in or out of the whole market with low costs, reasonable liquidity, and that the market will be roughly efficient when they do it. Without active investors, and this is a point that Charlie was touching on before, without active investors, you can't have an efficient market. You need active investors to create that price mechanism and what that does for the entire economy in terms of driving signals on where to grow and where not to grow in the economy. You need the active investors. If you know, to use Charlie's analogy, if passive investors were 100% of the market, think about that. You'd have a couple of index providers, largely S&P and Moody's in today's environment, that are making capital decisions for the capital allocation decisions for the entire economy. The good news is we're not there now. We're about 20% or so of the market right now is indexed in passive investments. But we do have to start thinking about the problem now, because it's not going to take getting to 80 or 90 or 100% before some of these problems will start to show up in the fabric of the markets. And just give a couple things to think about. We have situations where all investors seem to start thinking alike or acting alike in the past. Think about stock market bubbles. While not driven by passive investors have helped fuel those by buying into the largest companies that are going up. And when active investors are all thinking alike, we've seen it in the US tech and internet bubbles, we've seen it in housing bubbles, in Japan we've seen it. It's not good for the economy to have everyone moving in the same direction. You also have other market functions that break down when everyone's moving in the same direction. Think about Japan over the last 25 years with extensive cross-holdings of companies from corporate and banking investors that were very passive, never really trading, not taking any active role in corporate governance. Well, finally, recently with Abenomics, they've recognized this and started to encourage more active investors and even the corporate holders to take more active roles to help create that vibrancy that active investors bring to the market. And finally, I'll just leave it. Charlie used a reference to a metaphor from the UK, and I have one as well. About 4 years ago, a colleague of mine, Ren Chang, published a paper on the Millennium Bridge analogy. And the Millennium Bridge was built in London and opened up crossing the River Thames in 2000. And after 2 days, this brand new bridge, which was opened to much fanfare, was closed, and it was closed for 2 years. The reason why is they found that as people were walking over the bridge in crowds, the bridge would start to sway a little bit. And as it swayed, people changed their step pattern to sway a little bit more, and it would sway more and more. He used that analogy to talk about what happens when all market participants start acting in the same direction. You can start to have a breakdown in the functioning of markets, and it's something we need to think about. We think investors should have every option to invest in active strategies or passive, but I think we need to be really careful about policies or regulations that might push all investors toward one angle, toward a passive angle. Thanks very much.
So everyone grab their lapel microphone. And who from the audience was able to figure out the pattern of speakers? Anybody figure it out? Yeah? Exactly. It's reverse alphabetical order by last name. So you see there are patterns, and we'll see about how investors find them. I think I wanted to start the conversation off here by picking up on a comment that was asked in the first question and answer session in the audience, which is kind of how fair are these markets? There's much fanfare in the book Flash Boys by Michael Lewis and others who have kind of out there and said, you know, these markets are rigged for the little guy, for the average investor, for the person sitting at home thinking about investing, and that this is rigged in many ways and isn't a fair game. So how do you guys react to that kind of argument out there?
You want me to take it first?
Yeah.
Okay. Look, I'll give the institutional view. I don't think, there are definitely very sophisticated, informed traders in the market. And I think, so I think regulations that aim to level the playing field in particular make it hard to take advantage of passive retail, which I would kind of classify retail investors investing on their own accounts as kind of, broadly speaking, passive investors, because they basically ride the market where it goes. I think that, I guess my main instinct about that question is that it's an issue, but I also think that there is a law of unintended consequences that's brought us to this point where you have such a preponderance of high-frequency trading. And I think, and I'm going to reason by analogy to what I see playing out in slow motion in the credit markets, what I would argue are about 30 years behind the equity markets in the revolution. So, in the old days, when equity markets were, dominated by a smaller set of traders who probably traded less frequently and in bigger size, it was much more common to have an intermediated broker-dealer system, right? And I always describe, broker-dealers' role in the market as stepping in between the asynchronicity of buys and sells, right? When somebody wants to buy on Monday, someone else is going to come along and want to sell on Tuesday, but you need to bring the buyers and sellers together in time to cross that trade. And either people can sit around and wait for it to happen, or they can just offload it on a dealer who puts it in inventory and sits on it there instead. And then there's sort of economies to scale. If you have one dedicated person, you can sort of net out all those behaviors. Over time in the equity markets, what has happened is that the average trade size has been collapsing. The frequency and the volume of trading has been going up, but the individual bite sizes has been collapsing. And I would argue that has a lot of drivers, both technological and regulatory. But one of the drivers of it is I think some of the institutional problems that I alluded to, which is it's hard to trade a big block of risk. If you're a big institution trading against, and the world is populated by lots of small investors who actually, on average, probably have less information. They don't have big research teams that sort of know where the value is, having done the research. What's your best trading strategy? And by the way, this characterizes a lot of hedge fund strategies too. Your best strategy sometimes is just follow the trend, right? Figure out what the big guy is doing, and then, because he's informed, and follow him. And I would say there is a sense in which I think high-frequency trading, so whether this is disadvantaging the little guy or not, I think it does insofar as little guys, and I consider myself a little guy, invest in funds managed by Fidelity, and then I'm hoping Fidelity gets best execution, right? I don't really care if I have best execution. My IRA funds depend on Fidelity's ability to trade. And I do think that some of the rules that were designed to ensure best execution basically made it necessary for big guys to pretend and disguise themselves as little guys and to blow their big block trades into lots of little tiny trades, or to go to dark pools and things like this. So that's what I mean by unintended consequences. I think, to the extent that money is being managed on behalf of retail by institutions, and those institutions are now having a difficult time executing because of rules that were designed to protect a small retail investor doing a trade instead of the interest of the institutional investor doing the trade on behalf of the retail investor. I think that's some of the imbalance that I sense in the market. So I don't know if that's a great answer to your question, but I do think that's always what my mind goes to immediately when I think about those issues.
Sure. Maybe I'll jump in, Shirley, because you talked about some of the lack of liquidity in the bond market, but the contrast with the equity market couldn't be greater, right? I started at Fidelity 20 years ago, and if we went back, if you think about the cost to execute a trade, and the analogy Charlie gave is great. We do research, we come up with an idea for a company we want to invest in. There's really a few costs that enter into that. What is the bid-ask spread in the market at the time we're looking at it? What is the impact we have as we try and execute that order on a large institutional size? And then lastly, the commissions that we pay to the broker that helps us to get that trade done. Those markets those costs are down anywhere between 50 and 90% over the last 10 to 20 years, and they continue to go down. that is meaningful. I was doing the rough math in my head that if you buy a stock and hold it for 2 or 3 years, that might add a percentage point to returns that the customer is experiencing. Very, very meaningful, particularly in what might be a lower return world, as Susan was talking about. So the empirical data show that, particularly in the equity market, the cost to transact have come down dramatically. There are still issues, and some of the issues that were raised in the book are issues that we were aware of and would encourage regulators to dig into. It doesn't mean it's perfect, but the costs that the average investors are paying to execute trades, and the inverse of that cost is the returns they're experiencing are better.
I would add just a cautionary note as well. I mean, to look at what happens when markets are too dominated by retail investors, just go to China, Taiwan, Korea. They don't have institutional investors as we know them, large pension funds and professionally managed money. And those markets are very much dominated by retail investors. They've got extraordinarily high turnover, in the rate of, say, 500% per year, so each share being sold 5 times during the year by day traders. And it's just incredibly volatile. You've all probably noticed the wild upswings and then crashes of the Chinese stock market that really seem to have very little to do with current economic news coming out of the country.
Josh?
I think it's entirely unsurprising that the nature of markets is that people compete to get advantage in them. And so the idea that some institutional investors take advantage of the calculation, collocation, et cetera, to pick up, a millionth of a cent per trade is not a surprise. The fact that it's a subject of regulatory interest should not be a surprise. But I think of it as an issue between competing institutional investors over fairness among institutional investors. I think it's worth noting, since we're talking here about individual retail equity investors, that those market inefficiencies with respect to marketing, education, et cetera, are orders of magnitude greater.
And just to be clear, I know you're looking my way because I represent the institutional investors, but we are not high-frequency traders. We benefit from some of the liquidity they provide, but we are not high-frequency traders.
I would point out one other, like a growth business for the dealer community now is, the agency execution of block trades on behalf of smaller institutional investors. Fidelity is a sophisticated investor, but a large number of investors don't have the kind of electronic sophistication that it takes today to put a big block through the market. So how does that work? An investor who wants to execute a block trade brings it to Goldman, and then Goldman has sophisticated electronic algorithms that basically, it's an arms race, right? Our algorithms try to outsmart the sniffer algorithms that are trying to trade in front of us. And so we'll blast that trade out into thousands of little trades over several days. And so we are still in the business of servicing and intermediating that trade flow. But in some sense, it feels socially wasteful that we have to have this whole business dedicated to basically engaging the other side of the arms race with electronic trading. So I'm not casting aspersions at all. We also have electronic trading businesses too, right? So we're on both sides of that. So I'm not casting aspersions on electronic trading per se. I think it actually has generated tremendous efficiencies, and machines are cheaper than people when it comes to executing trades. But I also think that with it comes a lot of evolutionary technological changes that have, I think, sometimes counterintuitive negative consequences. And so to embrace transparency and technology as per se goods that always result in a better social outcome, I think is wrong. Just as perfect competition in the R&D business is also, or perfect transparency also doesn't lead to the best social outcome. So I just want to raise the question and sort of the recognition that I think speed, transparency, technology are not per se goods. You have to sort of ask functionally, what do I want this market to do for me?
So let me try to pick up a kind of theme that you raised and others have talked about, which is, you kind of posited that you have an army of research analysts, all Goldman Sachs, very intelligent people, and they come up and they think through and they find this great deal. And what's the little guy to do, as Josh has pointed out, now that we're kind of in control of our own future and retirement, and how in the world can we compete with you guys? And then I think a little bit about my personal experience, and I have done one smart thing and missed one great opportunity. The first smart thing I did was in the vein of financial literacy. When my nephew had just become a teenager and was asking questions about how stocks work, I sat him down and I told him, explained to him how you buy the future of a company, and I said, let's buy a stock together. What's a good company? And he, being a young teenager in Maryland who liked to play lacrosse, like most young Marylanders do, or many, said, Under Armour. It's this new cool company. All the kids are wearing it. It's really going to grow. And I have my Nikes, and I'm a different generation on your chart, and I'm thinking, great. We're going to get into American apparel made in Baltimore. That's really what the McKinsey Institute says where trends are going to go. And lo and behold, I believe, since I invested with him, because it was his choice, I think Under Armour has been one of the 5 top performing individual stocks in the last decade. Just split again. They signed Steph Curry. I think they said was worth $14 billion in market cap. So that was a brilliant thing. 2 months ago, I saw, like many other, middle-aged people stuck in SUVs with these giant car seats in the back. There's really new minivan coming out, or SUV coming out from Tesla. And I thought, gosh, this is the first cool thing in car I've seen to get me excited in 5 years. And I went to the showroom, and this was, 2 months ago, and I heard a bunch of other people talking about it in my age group. But rather than go and invest in the stock, which was down to about 150, 160, I saw it started to come up to 180. It was off of its highs. I said, well, I don't know. Why is the stock so depressed? And I didn't. Had I done that 2 months ago, I may even be able to afford one when they finally come out, since it's gone up $70 a share in the last 6 weeks. Is there a role for the little guy and retail investors to use their daily experience in life to invest wisely, even in the face of giant, well-armed research arms?
No. Absolutely not. No, if you study firms like Fidelity and the brokerage arm, Charles Schwab, TD Ameritrade, people who deal with the do-it-yourself investors, only about half of them are actually do-it-yourself investors. The other half want some form of advice. They want some form of guidance. They actually want the firm to take the management of their account and run it. And of that half that are do-it-yourselfers, probably about 20% are active traders, and they consistently underperform the market. So
what do you mean by active? I didn't buy Tesla. That was my mistake, was not being active enough.
Yeah, but when you go to cocktail parties, you always hear about the wins people have gotten. It'd be interesting to have a study of, okay, now you've told me about how many great stocks you've invested in, how many lousy stocks have you invested in. The reality of the situation is an active trader is generally defined as somebody who may trade 30, 50 times a year, right? And for those people, it's amazing when you look at what's provided to them in terms of information flow by a place like Fidelity. They essentially get, if you go into an active trader's bedroom, you will see like 6 computer screens throwing all sorts of information up. And in the end of the day, they don't do any better than an institutional investor. It's a bit of a fool's errand. The best thing to do is to sort of invest with an institutional investor pooled in, say, a mutual fund or something like that. So I guess, to get to what Joshua said, what these people really need is someone to help them out. And I don't think education is going to cut it, to be honest with you. Because think about this for a minute. I think about a relative of mine who rolled over their IRA. This man works, he's a union electrician, so he's got a great pension, thank God, because he rolls it over and he gets his advisor, invests it in a variable annuity with a huge commission and a huge trail, and he keeps referring to him as an advisor. I think I'm going to go meet this guy. He's very sophisticated. He's an insurance agent. Most people, there's so much information asymmetry that it's really hard to surmount it, even with education. So I think that's where some of the things that Joshua mentioned are so critical, about regulating and even the marketing of these products. So,
Josh?
I am not intending by this remark to be disrespectful to all the individual investors on the planet, disclaimer. But I think of a lot of day trading, not as an investment activity, but as a consumption activity. People like it. They like watching screens. They like making guesses. They like investing. There are other people who do something similar. We call them gamblers. I think it is a huge mistake to conflate this relatively small in number population of day traders with the very large number of individuals who were tossed into the pool of investment by the fact that their employers could no longer take care of this for them. And so I think our challenge is not to have a regulatory guidance system, et cetera, that works only for day traders. It is to work for the people who have no idea what asset allocation even means.
Could I just underscore that? I mean, I never bought a stock in my life, and I don't plan to. I think the task of regulating this in the best interest of investors, retail investors, is a high one, and I base that on experience of my father. He's a retired math professor, so he's nobody's fool, but he has some single stocks that he came into one way or the other, and so he asked his Goldman Sachs son, what should I do with these? I said, sell them 100% down, and buy a mutual fund, and which he of course ignored, and he's been and this particular stock had been up 100%, and now it's down like 70. And so he's actually net down. It was related to North American oil exposure, just for what it's worth. Anyway, I said, you shouldn't have that much of your portfolio concentrated in one stock, and it wasn't that big, but it wasn't nothing. And so the point is, I have the most paternal instincts toward my father and his investment portfolio, and I tried so hard to reason him out of that. And he had all the best reasons to listen to me, but he didn't. And so I don't know what that means the answer is, but I am a huge fan of reducing options in some ways to investors to some minimum degree, right? If our goal is to ensure the retirement prosperity of all Americans, then I think you have to some degree, I don't think, there's a balance here, but I do think it's sensible to some degree to think about ways to save them from themselves. And your worst instincts, by the way.
Let me add on to that. I mean, we have opt-in programs now for 401k because we know people don't choose to save. We like to consume now rather than save.
Great example.
But there are other countries. Australia has set up a mandatory savings. So not only are you opted into your 401k, somewhere in the order of 6 or 7% is taken out of your income every month and put into a saving fund that is then professionally managed.
And they're raising the rate. And they're raising the percentage of income.
They're raising the percentage, and their household saving rate was very low in the 2 to 3%, where the U.S. rate had fallen to, and now it's about up to 5%, but it's gone up near 10%. So there is a way of helping people, and it's called regulation. And I know in America that would be very unpopular, Uncle Sam forcing you to save. But if we want people to have money in retirement beyond Social Security, we may need to think about that.
I mean, Social Security was Uncle Sam forcing you into a defined benefit pension plan, and I think it's one of the most popular government programs to date. But speaking of government programs and regulation, there's a giant elephant in the room, so let's address it. And this is the new fiduciary duty rule. It's made a tremendous amount of news. What do you guys think? You heard Rick's kind of earlier point. They thought the final rule was better than the prior version. I don't know if you share that opinion or not. And then what's that impact going to be going forward? Josh, you.
As I said in my prepared remarks, this is a case in which the universe of retirement products has changed dramatically from a largely wholesale situation to a largely retail situation. And I kind of view most of government as trying to catch up with that development. And it requires government agencies to figure out how little do people know, what should consumer protections be, et cetera. There are plenty of people who argue that the Department of Labor may not be the perfect regulator for this because they do not have a history of product regulation or paying attention, et cetera. But it is clearly a fact that other government regulators were not stepping in, that this was a market where we had tens of millions of people and we had dramatically inadequate consumer protections. And so my personal view is, and part of the reason why I am a fan of this Secretary of Labor is that not only did they wade into this thicket politically controversial and substantive as well, but, and make a proposal, but they actually also modified the proposal as the financial services industry said, by the way, your best interest contract is operationally a little difficult for us to do and would muck things up and would actually scare people away, and so they've changed that. I think there is a general willingness to modify. However, from my personal perspective, I think it would be a mistake to treat that as the final form of regulation, because it really does, as I mentioned also, it really does rely on the fear of being litigated for violating fiduciary duty as the mechanism. It doesn't, except in very crude ways, talk about what is or is not a good product. It doesn't, except in very crude ways, even hint as to what reasonable fees are. And so from my perspective, it's a well-meaning early effort, but anybody who thinks this is the mature regulatory scheme for these consumers is kidding themselves.
You know, at Fidelity, as the CIO, I'm on the investing side of the business. So we're thinking all day about which companies to invest in and how to put those together in portfolios. There's another part of Fidelity that is the largest provider of 401k to defined contribution plans out there, and one of, if not the largest providers of IRAs. So this is very close to us. Not right in my wheelhouse, but it's been discussed around the halls a little bit the last week or two or year. And I would want to echo the comments we heard, though, from Mr. Ketchum before, that the final rule clearly demonstrated that the department listened to the concerns of the industry and made meaningful changes and improvements to get there. Now, we still want to work with regulators and work with policymakers to refine and improve it so that we can continue to offer the best products and services and education for our customers. We've heard a lot about individual financial education around investing. That's a key part that gets caught up in this ruling, in an area we need to continue to work with regulators to improve.
Yeah, the best way I heard this described is at a recent industry conference, according to the 5 stages of grief. And they were referring to all the brokerage firms that are dealing with this right now. And everybody's gotten through denial, anger, bargaining, depression, and they've now reached acceptance. And when you talk to the executives in the industry, we did a survey, in-depth interviews with about 50 executives on this topic. They're all trying to figure out how to implement it. They've all accepted it. And many of them actually are looking at some of these digital advice solutions that I've talked about, which are effectively ETF allocation products for some of the smaller investors. And the biggest impact, I think, is going to be for those firms that the large firms, the large bulge bracket brokerage firms already have their major, and interestingly enough, Joshua, this is a high net worth versus a retail lower net worth investor decision. The big firms will only accept a client who has $250,000 or more, okay? Those people are already in a fiduciary relationship. They're already in an advised program under the corporate RIA of the firm. That's already done. It's really the smaller investors who are going to be impacted, people who are typically much lower. The folks I talked about, the average investor who's essentially sold a commission product, an A-share mutual fund, a variable annuity. I think you're going to see a lot of these types of advisors challenged in how they redefine their practice. There's a bit of that 5% commission hit is almost like it's like a drug, and kind of getting off of that into a different relationship can be a challenging business model change, but I think that's what you're going to start to see, hopefully. And I don't think it is the end. I think we need to really stay on top of this. You know, paternalism isn't necessarily a bad thing, particularly when you're dealing with people's financial lives, and capital markets are really, really complicated for the average person to understand. So I think it's generally a good move. And I do think the original BIC contract was, you were supposed to have to, I think, hand it to the person before you even talk to them. And so before I can talk to you about what I'm going to do for you, I'm going to hand you this intimidating document that might suggest that I'm not being a good person for you. And so I think, the DOL kind of heard the industry that this probably wasn't the right solution, and they've done some things to modify it, but yeah.
Great. Well, I think we have some questions from the audience, and so why don't we start right there and then come over. And please introduce yourself and please ask a question.
Yes, thank you all very much. My name is June O'Connell, and you often hear corporate boardrooms say we're doing A or B for the benefit of the stockholder. And increasingly, as you all have described, more and more people are investing not as Susan owns 100 shares of Johnson Industries in Wisconsin, but Susan owns 100 shares, but Joshua owns 5,000 shares in a Vanguard managed fund that has a lot of either 401k money or IRA money. And you manage a stock index fund that includes Johnson Industries. So essentially, you have 3 different kinds of stockholders, yes? 2 of whom are passive, is my question. The one who manages the the managed fund, and the one who manages the index fund. Aren't they essentially passive investors with the companies? And does that then create sort of uber stockholders in the Susans who are active? Do you follow my question? Because everything is moving towards funds through retirement accounts.
So how does that affect?
But it seems to encourage a fixation in corporate boardrooms with those of us who are not active stockholders.
I think that's a very interesting question and a good concern. The time that any CEO spends and any CFO is an increasing amount of time with their major shareholders. And you're right, the passive index funds don't get as much attention, but who really gets attention is not me owning 100 shares, but it's major hedge funds who can move the price, and active equity investors. So I'm sure Tim gets a lot of attention from these folks, but it's becoming an increasing role of both the CFO and the CEO to communicate and manage expectations, communicate company strategy and where's the company going with the major shareholders. And you're right that they focus on the most active, the squeaky wheel gets the attention.
I'd just make one small distinction. There are different types of passive and active investors. But a typical passive fund, and Fidelity manages those as well. It's a different area, but we manage those as well. While they don't, if you think about the ways that shareholders can influence a company's strategy, capital decisions, et cetera, the first way is by buying or selling that security, which reinforces, it impacts the price of the stock and would reinforce, hopefully, positive behaviors that are good, and also the opposite. The second way is through voting the shares, voting in the proxies. So voting for managements, voting for boards of directors, other proxy items that come up. The passive investor is not making a conscious decision on the first thing. They're going to own that stock. If it is in the index that they're tracking, they're going to own that stock in good or bad times. The second element, though, is still an active type of decision, I guess, for a passive investor. There's been a lot of literature and a lot of press about how active that decision is, but it is an independent decision and still a fiduciary responsibility of the passive and fund companies to vote on proxy issues, to vote on any board-related issues in a way that they think is best for their shareholder customers.
Okay, I think we have one question over there, and then we'll go to Martin.
Hi, Tip Ghosh. This is a question for Tim, but for the rest of the panel as well. And we have negative rates, 0 interest rate, very low interest rate environment, cost of money being low. For individual investors, the search for yield is pretty difficult when it comes to choices. So even within the equity market, especially the way that the equity markets have functioned this year, it's not exactly a great time for individual investors. So how do you, when you're dealing with either individuals or groups of individuals in our current market environment, how do you, what kind of advice would you give them?
Yeah, so I'm not going to give individual investment advice, and that's actually not what we're doing, because that said, your statement is true. It's very hard to find yield. We don't have negative rates now in the United States, but a lot of parts of the world do. A lot of that's been driven by policymaker central bank decisions, which I don't think are necessarily, again, my view, I don't think are necessarily the right decisions to be going there. But fortunately, we're not there in the U.S., but we have very, very low rates, and it's hard for investors to find yield. You know, part of the discussions I think we had about the markets, I think there was universal opinion here on the panel that the equity markets are not rigged, and it's not rigged against the small guy. Yet the reality is, the perception is that it's still, that is the case in large parts of the market. And now is a time where maybe it's not a bad idea for investors to look for yield in the equity markets, because it's actually a lot higher really across the board than it is in traditional fixed income markets. But I think some people are afraid to do that because there is this perception that the equity markets are a challenging place. So it is a real issue, but I'm not going to give specific advice for folks.
Thank you. Martin Bailey, Brookings. If you're a listed company on the exchanges, it can be a hassle. You have to file quarterly GAAP earnings. You have to be subject to earnings pressure and a lot of other things. If a lot of companies react to that, do you see a trend towards going private, either private equity or privately held companies? And is that going to be a problem for the retail investors that may not have access to those companies? Is that something that retail investors should be worrying about, or it's not significant?
I'll take a crack. I actually was thinking of exactly that in response to the previous question as well, because I think among high net worth investors, there's a trend toward investing in private equity as opposed to public equities, on the view that the expected returns in public equities are much lower than private equities. And I think there's a lot of reasons for that, not least the fact that global investors come to U.S. markets, and we have an expression, in the credit market, at least that was true up until this year, which is that everything with a CUSIP, whether it's bonds or equities, is too expensive, right? But that's a tribute to their accessibility, right, and the desire of investors globally to invest in U.S. markets. I do think that it sort of points to the larger importance of ensuring that public markets, to prevent them being chronically overpriced, you need to make them functionally useful to the suppliers of assets, right? And the only way to offset the excess demand for securities is to create more supply of it. And to your point, the supply of public securities has been declining in the U.S., and I think that's for some good reasons. Some of that supply has been repatriated, but it's also, I think, for bad reasons. Partly that it's a hassle and there's liabilities and there's a whole overhead cost of being public. But it's also, I think, a function of the markets themselves not being as useful to the companies. And in part of being useful, I think, to the companies is being efficient, right? If markets aren't efficient, if they just paint you with a broad brush, you're an oil company, you're a tech company, and that's as far as it goes, well then, you don't stand out and you don't get paid for being a better company.
I love the chart that I think you had, Josh, up, which showed the timeline of passing ERISA and the participation in various types of retirement savings. And intentionally or unintentionally made me think about maybe the risk of unintended consequences from regulation. I haven't looked at this, so I probably shouldn't speculate, but I will. I would bet if we looked at the chart of IPOs in the U.S. or even the United States share relative to other markets, and we looked back to the early 2000s, when there was, for good reason, new regulation around public companies, disclosure, Sarbanes-Oxley, and other things, that was probably about the peak in IPO activity in the U.S. Companies are waiting much longer to go public. It is more costly. And again, it's not that the ideas behind some of those regulations were bad ideas, but we do hear from companies in terms of why they're staying private longer. Part of the reason is some of the regulation. The second part of the question, though, in terms of investors being left out of it, it is a lot. It is harder to get access to that, but not impossible. At Fidelity and other mutual funds, we do invest small parts of our funds in illiquid, less liquid securities. I don't want to say illiquid. There's always a market at some point, but that don't have CUSIPs, that aren't quoted on exchanges every day, in private companies. So not just the private equity and venture capital, which most folks don't have access to through their 401ks. The mutual funds, on our fund, some of them, but it's on the order of 1 or 2% of the fund type of size. So there is some exposure to that in the public markets.
So I think we have time for a couple other questions. I see a couple hands raised. I think in the back you've yet to ask a question, and then we'll combine a couple of the last folk.
I'm curious, in the sustained low interest rate environment we've had for 7 or 8 years, do you get any sense that hurdle rates in the financial industry have been adjusted downward?
One word answer is absolutely. Absolutely. Much faster than they did pre-crisis, right? Because everybody learned from the crisis that it was a mistake not to adjust your hurdle rate to the opportunity set.
And when you say hurdle rate for the benefit of everybody?
Yeah, so for example, let's say you're an insurance company and you're selling, you're selling liabilities, let's say that need to be funded with assets that meet at least you're assuming a 4% return, and then the opportunity set drops to 3%. And the question is, do you adjust your insurance products to match down and offer a lower yield on your liabilities to match the assets that are available to fund those? And I would argue that in the pre-crisis period, insurance companies were, I'm just using that as an example, but it describes a whole host of institutional investors. They were reluctant to give on the product offering, right, for competitive reasons, and as a result got sucked into higher yielding, riskier products that they probably should have avoided, and certainly in hindsight would have been better off avoiding. And I think the consequence of the crisis experience, was a very painful lesson that, let's be disciplined on our product offering so that we don't become yield pigs.
Now, I would say in the retirement market, the equivalent of the hurdle rate is the actuarial discount rate. And in that market, for a variety of institutional reasons, they have in fact recognized that the world has changed, but with such a lag and to such a minor extent that it has created a transparency and accountability problem. There's a divide because Congress in private retirement plans mandated, not exactly, but in effect, that you follow a corporate bond rate. Whereas in the public retirement plans, they were left to the vagaries of the actuarial profession. So it really does vary. And I would say, unfortunately, for the retirement market, it's marked to market over a generation rather than over a year.
And even more unfortunately, in the corporate sector, where you would want to see companies undertaking investments, recognizing the new now sustained low rate interest rate environment, they haven't changed their hurdle rate. So when they consider new investment opportunities, they consider the low rate environment to be temporary. And it's one of the reasons why investment in many countries around the world isn't as strong as we'd like it.
I wish we would reduce our hurdle rate for infrastructure investment as a public policy, but that's neither here nor there. I want to really thank the panel. This has been a fantastic conversation. I thank the audience for their engagement. I know that we're joined by our next speaker, so let me turn that over to Martin, and please join me in thanking the panel for this conversation.